please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's send it out now to Dom Chu for a quick market flash here. Dom.
All right, so Sarah, shares of Dynegy moving in the opposite direction here, spiking on a Dow Jones report, citing sources saying that Vistra Energy may be in advanced talks to combine with Dynegy. Now, these are two big independent power producers, in essence, folks that own power plants. They each have an enterprise value of over $10 billion, although the equity side of things for Dynegy is more like $1.4 billion, and of course for Vistra around $8.5 billion. Sources tell Dow Jones the deal could be announced as soon as next week, but of course, Bill, Sarah, the usual caveats apply. Deal talks could still fall apart, but it could be a very big combination of two Texas-based power producers, one with significant operations in Texas and the other with operations all over the country in Dynegy. Guys, back over to you.
Not a done deal till the ink is dry.
No.
Thank you, Dom.
You got it.
See you later. Meantime, shares of GE sinking yet again today, down around 10% since the company reported those earnings on Friday. And on that day, CEO John Flannery told CNBC the company's cash flow for 2017 was, in his words, horrible. Let's bring in our Morgan Brennan with a look at the stock's rapid decline this week. Morgan?
Hey, Bill. Yeah, so it has been a rapid decline. GE now trading at just under $21.50 per share. That is a more than two-year low. This is the worst weekly performance since May 2010, and it's only Wednesday. If shares fall further than 10%, this could be the worst week since May 2009, the recession, when GE traded for just under $13 a share. All of this due to dismal earnings and cash flow, growing expectations that the dividend will be cut, especially since new CEO John Flannery has not actually said that it's safe. A wave of analyst downgrades this week, and then, of course, blowout earnings from other industrials like 3M, Caterpillar, and Honeywell, which have been a stark contrast to GE. All of those factors are pressuring the stock. Meantime, Flannery did speak today from San Francisco at GE Digital's annual Mind and Machines conference. Former CEO Jeff Immelt invested billions of dollars into making GE a digitized industrial company. There had been some speculation about just how much Flannery would support that vision, given his focus on cost cutting. But today, he did say GE's, quote, all in on digital because the, quote, company that just builds machines will not survive. Also, details about that dividend, divestitures, also new 2018 financial guidance. They won't get that until GE's investor update on November 13th, and shares are under pressure. Guys, back over to you.
All right, we'll see what happens until then. Morgan, thank you. We've got a news alert here on an FCC rule that limits TV and newspaper ownership. Julia Borston has the story. Julia.
Hey, that's right. FCC Chair Ajit Pai announcing that it will plans to make changes to its long-standing media ownership rules, and it aims to eliminate the limits on local ownerships of TV station and newspapers. Chairman Pai outlining a plan that the FCC says it now will vote on November 16th. That's the next big FCC meeting, and the rules would be able to take effect soon thereafter. This is something that newspaper owners as well as TV station owners such as CBS and Fox have wanted for a while. We even could see more media consolidation as a result of the changes in this rule. Back over to you.
On the deregulation push. Julia, thank you.
Big time.
Time for a CNBC News update now with Sue Herrera. Hi, Sue.
Hello, Sarah. Hello, Bill. Here's what's happening at this hour, everyone. Whether or not 401k contributions will remain tax-free appears uncertain. Today, the top Republican tax writer said changes could be part of his party's overhaul. But when asked if the 401k tax break was on the table, President Trump seemed to soften from a tweet sent a few days ago where he promised no changes.
Well, maybe it is, and maybe we'll use it as negotiating. I think Kevin Brady is fantastic, but he knows how important 401ks are.
Walgreens announcing it will close roughly 600 drugstores nationwide as part of its $4 billion deal to buy its rival Rite Aid. Most stores will be under the Rite Aid brand. A list of the locations has yet to be made public. Why shouldn't you toss your goldfish in a pond? Because they grow up to look like that. Wow. Officials in Ohio released these images as a reminder to residents not to release their pets into local waterways. There you go. That's the news update this hour. I'll send it back downtown to you, Bill.
It's electric.
Wondering what's wrong with a large goldfish. I don't know.
Well,
But
they tend to be
don't know
predatory
either.
to other fish that are in the pond.
I see. Thank you, Sue.
You got it, Bill.
See you later. See you next hour. Coming up, as we mentioned, Boeing dragging the Dow lower today despite beating on earnings and raising its guidance before the bell this morning. We're going to tell you why that stock is selling off when Sarah and I come back.
Of 8% through August. Also, cargo traffic is experiencing a healthy recovery with 10% freight traffic growth over the first 8 months of the year.
Okay, so it wasn't a perfect quarter. There were a couple of notes in there that got a little bit of attention. First of all, they are taking a charge of $329 million, or they did in the third quarter, as they continue to wrestle with getting the tanker refueling program up and going. The first planes are expected to be delivered next year. That's the latest charge that they've taken on that program. Still, as you take a look at shares of Boeing, this is a company that raised its guidance for full-year earnings by another 10 cents today. Yes, it was due to the fact that they have a lower than anticipated tax rate, so they're going to have a little bit stronger earnings. But their operating cash flow up $500 million in terms of the guidance for the entire year. So altogether, I know it doesn't look like it when you see a stock down more than 3%, guys, but this was a relatively strong report from Boeing.
After a relatively strong performance for the entire year, taking 50 points off the Dow today. Phil, thank you.
Thanks, Phil.
You bet.
The biggest winner on the Dow today is actually Nike. Shares getting a nice little pop on the company's bullish outlook that it just laid out in its Investor Day. Ahead, we've got an exclusive interview with Nike Chairman and CEO Mark Parker to get all the details. Don't go away. Led lower by telecom, industrial, and energy shares. As for the Dow, you just heard the two stories. Boeing and GE are the biggest losers. But Nike is the biggest gainer on the back of those comments at the investor conference that they've been holding in Oregon today. And ahead, we're going to tell you what was said that's driving that stock higher. And still to come, renegotiating the North American Free Trade Agreement and tax reform, both at the top of President Trump's agenda right now. You will hear from Commerce Secretary Wilbur Ross about the progress on both. That's coming up on Closing Bell. Start with that. We'll start with you because you're bullish on this stock. This idea that Einhorn says just because you can disrupt someone else's profit stream doesn't mean you can earn profit yourself. And he's a little puzzled by that and Amazon's valuation in that context. Clearly, the market doesn't think so. Take the other side.
Sure. So the other side is that 51% of units sold on Amazon in the June quarter were third party. If you look at their buckets of profitability, their cloud computing is number one, their third-party retail effort where they're collecting a commission on a sale and not being first-party retailer is number two. I think 51% could be 75% over time. That's a big bucket of profitability. So I think that there's a lot of upside to margin for Amazon longer term.
Tim, you're our bear in this case. You're a value player just like David Einhorn. Now, he has chosen to short Amazon, but you haven't. Why?
Well, we are not a long-short investment advisor, so we are a long-only shop by it. So by not owning something, I'd say, therefore we would be a bear on it. And I don't think we're a bear on Amazon's ability to run a business, their ability to take share, their ability to disrupt other businesses, similar to what Einhorn said. The problem is that they don't do it with any profitability. And at the end of the day, earnings are what matter. And we're just not willing to bet 5, 6, 7 years in advance for them to finally make some money.
But isn't the point that they could? They could stop. I mean, they could stop spending like crazy to grow market share and earn a profit anytime they want. And in fact, we've seen that even in recent quarters.
Well, I mean, they were founded in 1994, and we have yet to see a consistent string of earnings. So hard to say that the Tiger is going to change its stripes now and suddenly become a better capital allocator or drive profitability. And even if they did, you're talking about 250 times earnings. So the amount of earnings they would need to generate to justify the stock price really would have to be pretty significant.
Tom, you have to admit, I mean, even as other retailers struggle mightily this year, this has been a watershed year for Amazon. It seems like they are everywhere, and we talk more about the Amazon effect that it has on other retailers every time they announce a new initiative. Are you worried that they're trying to...
companies, too.
Yep. Are you worried that they're trying to do too much at once?
No, I definitely think that the big key areas for Amazon on advancing their influence and advancing their wallet share is in the grocery category where you saw them buy Whole Foods, and everything they're doing on the apparel side, especially their efforts on women's apparel, which has historically been more difficult for Amazon to pursue than men's apparel. And I do believe that they have the capacity to go after all these opportunities. And what people often forget about Amazon is they're not beyond exiting something that isn't working. So, for example, I cover QVC. They had a very short-term initiative they called Style Code, which was video retailing effort, live programming, promoting apparel. It wasn't working for them, so 6 months later they turned it off. So Amazon, yes, they enter a lot of categories, but if it isn't working, they're not afraid to stop and pursue something else.
All right, we'll see what those earnings look like tomorrow, what the guidance, the all-important guidance looks like. Tom, Tim, thank you both for joining us on Amazon today. Appreciate it very much. The Dow's down 120 points off the lows. We have our closing countdown coming up in just a moment here. Be right back. It's first investor day in 2 years. Positive comments from their new CEO, Mark Parker, and you will see him with Sarah next hour. Should be very instructive to hear what he has to say about a lot of issues facing that company right now, most especially in the very, very competitive retail business. Boeing, even though they had the good earnings, Phil LeBeau telling us the stock is down 3%. That's been the big laggard on the Dow today. For the 10-year yield, the March continues higher, 245 for a time today, the highest yield we've seen since March. We're at 243 right now. Oil down today. We had a surprising build in inventories on crude oil, and price went down a bit, down 29 cents today. So we're now on WTI at 52.20. And Bob Pisani, look at this. What was creeping a little bit higher, although it's off the eyes of the day, the volatility index, our friend the VIX.
Thank goodness.
Actually hit 12.
It's about time something happened.
Today.
Remember, we used to not pay attention to this until it turned to 20. Now we're making a big deal about it. That's how things have changed. Here's what we learned today. We learned that the market most cares about a sudden spike in interest rates. That's what we've learned. The market doesn't care whether it occurs because economic news is better than expected with the durable goods, or whether Mr. Taylor might be in on the Federal Reserve, or whether there's an inflation spike. The CPI is going to be on Monday. What we learned, the message of the market is it cares most about a sudden spike, and it doesn't like that. And when that happens, the big momentum names, including your Boeing, which had a decent report, sell off.
And we also have earnings coming up. Those count too. We have 4 companies reporting that we'll be highlighting coming up in the next hour or so, including Las Vegas Sands, Amgen, and Buffalo Wild Wings. We also have Commerce Secretary Wilbur Ross on the tax reform package, and the CEO of Nike exclusively with Sarah Eisen coming up on the next hour of the closing bell. Thank you, Bob.
Welcome to the second hour of the closing bell. I'm Sarah Eisen in for Kelly Evans today. Here's how we're finishing up the day on Wall Street. Another down day, the second one in the last 3 sessions here. It looks like the Dow is closing out with a loss of about